Thank you for joining me this Friday, the 5th of July. I'm Grady Wolf, market analyst at Bell Direct, and this is the weekly market update. The utilities sector is up 13.01% this year as investors seek out diversified exposure to the AI revolution. The utilities sector encompasses listed companies that provide basic everyday amenities, including gas, electricity, water and power. Through the rise of the AI revolution, the need for power and water has risen astronomically. Natural water is one of the world's scarcest natural resources, and the AI revolution threatens to diminish remaining supplies even faster. Firstly, AI servers that run in data warehouses require massive energy consumption, thus generating excessive levels of heat. In order to maintain operations of the servers, data centers commonly use cooling towers, which require a vast amount of clean, fresh water. Secondly, generating the electricity required to power AI servers consumes a lot of water through cooling at thermal and nuclear power plants, thus also enhancing consumption of water off-site too. Finally, the AI revolution water consumption is also increased throughout the AI supply chain, with approximately 2,200 gallons of ultra-pure water, or UPW, required to produce a single microchip, according to OECD AI. Water withdrawal is the amount of fresh water taken from the ground or surface water sources, while water consumption is the amount of water evaporated, transpired, and incorporated into products or crops, says the OECD AI. Estimates of water withdrawal result in approximately 4.2 billion to 6.2 billion cubic metres of water withdrawal required in 2027, which is more than the total annual water withdrawal of Denmark alone. Water consumption estimates point to the need for around 0.38 to 0.6 billion cubic metres of water needed for AI annually. Together, these estimates indicate the need for over 7 billion cubic metres of water required for the AI revolution to work per year. With this in mind, which stocks on the ASX may see increased demand through the growing need for water in the AI revolution? Duxton Water, ASX D2O, is Australia's only listed ASX vehicle, providing investors with direct exposure to the Australian water market through its portfolio of water entitlements in the southern Murray-Darling Basin. With analysts expecting water utility stocks to have an annual earnings appreciation of 36% over the next 5 years, this puts Duxton Water in a favourable position in the current market landscape. Elsewhere in the utilities sector, electricity and energy are also required to power the AI revolution. A recent study by Goldman Sachs outlined that US utilities will need to invest around $50 billion in new generation capacity just to support data centers alone, while the AI is set to drive a 160% increase in data centers by 2030. The World Economic Forum also outlined that the energy required to run AI tasks is already rising at an annual growth rate between 26% and 36%, meaning by 2028, AI could be using more power than the whole of Iceland used in 2021. In Australia, Morgan Stanley Research expects data centres' uninterruptible power supply requirements to increase from 1,050 megawatts in 2024 to nearly 2,500 megawatts in 2030, with the surging demand expected to place further pressure on nuclear energy and renewable power purchase agreements. Australian electricity and gas giants AGL Energy, ASX AGL, and Origin Energy, ASX ORG, are poised to benefit from the rising demand for energy from AI data centres, with both companies posting strong gains over the last 12 months. On the data centre side, NextDC, ASX NXT, is developing major data centres in its $1 billion commitment to service the growing demand for the AI boom. Earlier this year, the company's chief executive, Craig Scroggie, said Australia should be considering nuclear power to supply the growing power needs for the AI revolution. From here, investors looking for potential exposure to the AI revolution can consider direct exposure through providers like NVIDIA, data centre exposure through ASX-listed Goodman Group or NextDC, or utilities exposure through AGL Energy, Origin Energy or Duxton Water. Locally, from Monday to Thursday, the ASX 200 recovered from a sell-off early in the week to post a 0.83% gain across the 4 trading days, primarily driven by the US hitting record highs across the Nasdaq and S&P 500. Energy stocks led the charge this week with a gain of 4.13% amid the rising price of oil, while materials stocks also rose 3.83% over the week. The winning stocks on the ASX, or the key index, the ASX 200, this week were led by Whitehaven Coal jumping 16.86%, Coronado Global Resources rose 13.08%, and Stanmore Resources added 10.17%. And on the losing end, Strike Energy tumbled 19.64%, West African Resources fell 14.6%, and Pro Medicus lost 9.67%. Across the broader market index, the All Ords rose 0.82% this week as Lydian Resources and Phoenix Resources rose 28.57% and 20.63% respectively. The most traded stocks by Belterac clients this week were Commonwealth Bank, Drone Shield and Rio Tinto. Clients also bought into Fortescue, Woodside and Pro Medicus, while taking profits from Magellan Financial, Centuria Industrial REIT, Whitehaven Coal and CSL. And the most traded ETFs by our clients this week were led by Hyperion Global Growth Companies Fund, BetaShares Australian Dividend Harvester ETF and Magellan Infrastructure Fund. Taking a look at the week ahead on the economic calendar, Westpac consumer confidence data for July and NAB business confidence data for June are released on Tuesday. Overseas, China's inflation rate for June will be announced on Wednesday, with economists expecting a flat reading of 0.3%. China's trade balance and GDP data are also out later next week, with the forecast of an increase in trade surplus to $85 billion and a decline in GDP from 5.3% in Q1 to 5% in Q2. Chinese retail sales and industrial production are also out later next week, with the forecast of a decline in both readings as the region continues to struggle in the post-pandemic era of recovery. US core inflation data is out next Thursday, with the market forecasting a slight decline in the inflation rate from 3.3% in May to 3% in June. Any reading higher than the forecast will signal inflation remains sticky in the world's largest economy, and we may see an equity pullback during that session as investors fear a prolonged rate hold out of the Fed. If you found these insights useful, don't miss out on our special offer available right now. When you join and trade with Belterac, you get access to more than 150 Bell Potter research reports and live streaming data for a year on us. It's usually $330. This offer is available for a limited time only, so join today. And that's all we have time for this Friday. Have a wonderful Friday and weekend.